Hey everybody, it's Pete. Good morning. It is Monday, June 22nd, 2020. Hope everybody's being safe depending on where you are right now. It seems like there's conflicting stories on how the pandemic's doing, so I just hope everybody's doing the smart thing, being safe. We actually have a guest star today, Solomon. Solomon joined today's videos. I want to talk about managing risk in today's episode of Stocks for Breakfast, and specifically different scenarios in the market with how to manage risk. But first, actually, a big part of it is a mindset. And we're actually going to get into some very specific and two dramatic examples from last week, specifically last Friday. Um, and it starts with the fact that, first of all, congratulations to everybody who signed up and enrolled in the boot camp last week. You made just an amazing investment in yourself, and we seem to be having a really what's the word I'm looking for? Helpful community. I guess that's really the best way, and that really makes me proud. So I just want to thank everybody who's in the community that helps other new people that come into the community, especially Ron Hazlitt. He put up this really big, long introductory post to the new people coming in and his experience on how to navigate if you're brand new, especially. What I want to talk about today, though, is there's feedback that came in from new members of the community, which I think is interesting, but I guess interesting because everybody's at different levels of trading experience, is this thought process that when you put on a trade that you are either getting stopped out or you're going to hit your profit target and you don't do anything in between. Where it's like, I'm losing all that money or I'm making all that money and I'm not touching the thing in between. Nothing in the world could be further from the truth than the fact that you just leave it alone. That's not the way we manage risk. That's not the way that you would ever manage risk, especially if you have the opportunity to do something about it, which we absolutely do. So I want to briefly discuss the concept of, as we discussed in last week's presentation, your perfect trade scenario where order flow is super obvious, and you have your A-plus trade unfolding, and you would tend to hold those trades because everything's working out perfectly. But what if it doesn't? What if you put on what you believe is a good idea and the trade slowly starts to leak against you? What if you put on the trade and the market just absolutely collapses while you're in the position? Now, obviously, something else that's a big thing to know is it a day trade that you entered or is it a swing trade? Are you entering day trades with the intention of holding a swing trade, those are three different types of trades. You know it's only a day trade, you know it's a swing trade, and it's a day trade you plan on working, which, by the way, that last one is a lot easier to do because you're not going in with your full share size and just saying, I'm going to hold this. If it moves against me a big dollar amount, I'm just going to leave it alone. You don't have to do that anymore. When I first started trading, it was $125 per trade. So $65 in, $65 out, or $67.50, I think it was, on each side. So back then, things were trading in fractions, and you literally had to take into consideration the cost of commissions with how much money you could make on a trade. Now, I know for those of you that hold trades a long time, that might not be that big of a deal, but think about it. Imagine every trade right now that you were placing, it cost you $125 to place the trade. It was a really big deal that you had to make a certain amount of money just to break even on the trade. But we're 100% in the 180 degrees in the opposite direction now, where commissions are really a non-factor. And we won't even get into understanding how to capture rebates, ECN rebates and whatnot. This is really just effective. All of the brokerages, not all of them, majority of them have lowered commission. So you never really should even hold the trade because you don't want to pay commission. It's just flat out dumb. And even if you did pay a commission, $10 versus losing $500, it doesn't make any sense. So here's the concept first, and then we're going to go over to the charts. So let's say, for argument's sake, you put on a trade, the market starts to move in your favor, and you start to build that position and add to it as it moves in your favor for however long you plan on holding it. Day trading, position trading, you might not do that as much, but if you're looking to build a position to hold over a couple of weeks, absolutely. As it starts to move in your favor, you add a little bit more here, add a little bit more here, which, by the way, proper pyramiding as a stock moves in your favor is you always buy less shares as it moves in your favor from your original purchase, because you don't want it to be top heavy where if it starts coming down, you are losing more at a worse price You want to have the most shares on your initial entry and lower shares as it moves in your favor. So that's a money management wisdom, for lack of a better way of putting it. Definitely a money management principle is probably the better way to put it. But what if you put the trade on and it starts going in the other direction? What do you do? Well, here's what I do. If I put a trade on and I absolutely love the idea, but it starts moving against me, which quite frankly is reality, it happens to all of us, what I'll do is I'll reduce my share size. See, there's a difference between a trade not working out, a trade moving against you, versus a bad idea. If I put on a trade that's a good idea and it simply doesn't follow through, or maybe it's a good idea and the market just turns around, so a lot of stocks turn around, which we'll take a look at that in a second. What do you do? If I have 1,000 shares and that happens in a big way, I'm not saying it goes up and goes different. What I'm saying is it goes up, pulls back, and starts to go down. And we're going to talk about a stock in a second. What do you do? Well, Nick actually in the room had asked that about a trade that he was in, and I reduce your share size. There's no reason to have X amount of shares. The thing starts moving against you, and you're like, no, I know how much money I want to make, so I'm just going to sit in this position. In this day and age of zero commissions, get out of some shares, reduce your risk, reduce your leverage on your initial position. If it starts to move against you, you're losing less on a good idea, and it allows you to reevaluate whether you want to be in the position or not. If it continues to move against you, then you can pull the plug on the entire thing, but you're pulling the plug on now what was a much smaller piece of the original trade. So the other part of the trade is, well, what happens if it starts moving back in your favor? Well, immediately when you start to reduce your share size or lower your leverage, you should immediately be putting alerts back up at a price level that says, okay, if it gets back up there, I want to know. Because that means that the idea, for whatever reason, maybe it was just one candle that took you out. And Chris, this happens to you a lot. We're actually going to take a look at one of your stocks, Chris Glander, that it goes down, takes you out. Set your alert immediately so that if it gets back up to that price, or if you're an advanced trader, you can set a buy stop, in this case, up in that area for even 100 shares. It'll light up in your system. You'll see you got filled, and now it got back to that level. Maybe that moment you got in was just a moment where it just didn't work out. That 5-minute window, that 10-minute window, that half hour, whatever it happens to be, you want to get back in. Put the trade back on. So it's very common for me to have a trade. I put the trade on, starts working out, dances around, moves in my favor. I'll add to it. If I should happen to get in and it does nothing, I'm not touching it. If I get in, but it pulls back, I'm going to reduce my share size. There's no way in the world I'm going to be like, well, I said that's how much I was going to lose, and I'm going to lose it. Damn it. No, it doesn't work that way. Not in the professional trading communities. There's nothing wrong with working in order. So we're going to take a look at two stocks, because the obvious question that you're going to have now is, and a lot of what I do and what a lot of professional traders do, which is probably influenced by William O'Neill's book, How to Make Money in Stocks, is we first and foremost get a really good idea of what's going on in the market. And then once we have a grip that the market is absolutely right now trading with either bullish or bearish order flow, so let's use bullish buying examples, then you tend to go to stocks that are strong. But there is every once in a while a stock that fights the market, where it's on its own dance, the market going down like it did on Friday, but this particular stock actually moving up in a strong way on Friday. So what do you do in that circumstance? You're trading your stock. You're not trading the market unless you're trading ETFs or specifically E-mini, S&P, or NASDAQ, or those kind of things. So we're going to take a look at two examples. We're going to analyze the trade just using the daily charts and whether or not it was a good idea. The cat's still here. And what you would have done. But specifically, I want to walk through the trade that Nick was in, and then we'll take a look at the other one that that was called out as well. We're going to use tape reading skills here as a skill building exercise, for lack of a better way of putting it, so that you could, again, just look at anything and understand that you know how to read the tape right now. Just need to step up past chart reader and actually learn how to make money. Remember, we talked about that in the presentation last week. The difference between somebody who's a really good chart reader but not making money is you have to first learn how to read the tape, which we're going to talk about a little bit about that today. But then the next step after that is learning how to be a trader, which means you understand what to do between entry and exit, sorry, which is what we're going to discuss a little bit right here. So we're going to go over to the charts, And we're going to specifically talk about when. Now, we're not going to necessarily talk about whether it's an awesome idea or not, but what we did discuss when we were in the room on Friday was the fact that it held the support level once, twice, three times, and basically four times. And we said, okay, if we get a higher opening, especially an opening above the previous day's high, which we actually got here on Friday, we'd be looking to see the stock turn around and hopefully some momentum move to the upside. So we actually did get that opening. So what I'm going to first do here is I'm going to draw the opening price. So that's the opening price, the opening print on Friday. So you can see that the stock, for the most part, was trading below the opening price in the morning, but certainly not collapsing. So Nick had typed in the room, what should I be doing with my position? And this is a big advantage of working together real time too. That's a big plus with the boot camp. We took a look at the SPY really quick, and at that same time, the SPY was basically trending down the entire day and also kind of well offered the entire day. So the SPY was getting crunched while the stock was still strong at that point. And strong is relative. Strong meaning it was trading above the previous day's high. So that's really the barometer that we were using. And again, this is all learning how to read the tape. So despite the fact that it was below the opening price, which was this candle, we were still above the previous day's high, which was the opening that we planned, which, by the way, we have a lot of people write in and ask, how heavily focused are we on the open? Do we have plans for the open? Yeah, 100%. Most of the money is made in the first 90 minutes of the day. So those of you that sent over emails or requested questions about that, trading the open is a huge part of understanding how to make good money in the market. There's often trades that we buy on the close and sell on the open, and then we have very specific trades in the morning for a higher push or a lower push and specific entries for how to do that. But I want to stick to this trade and win. So it was right around this point where the market was collapsing when Nick typed into the room, what should I do? I'm looking to hold this trade longer, meaning turning a day trade into a swing trade. And I said, look, if the trade's not doing what you expect it to do, just reduce your share size. There's nothing wrong with lowering your exposure in a position, and you can always put it back on. So that begs the question, okay, before you just said if you reduce share size, then you'd want to know. Well, what you'd do then is you could see clearly here what we call the opening range. I would have set the alert, which is what we did, at 90.75. So we reduced share size over here in exchange for wanting to put those shares back if we traded back above the opening range. So what ends up happening is reducing shares here, the stock absolutely collapses. So he's not in full position. He's not all beat up because the stock is coming down, and maybe even got out, I don't know, while the market was pulling back. But the point is he acted like a professional, first by asking the question, what do I do? How would you manage it? Which is obviously the big key to us working together in the boot camp in real time. Then lowering the position, if and when the stock turns around, your alert triggers, you put the shares back on, but in this point it didn't. So just the very act of reducing share size when the market and or your stock is not doing what you need to see it do saves you thousands and thousands of dollars each and every month if you're an active trader. And think about what that saves you over the year. So now you're in a position where you're not only getting your buying power back to put on another trade, you've also cleared your head. So remember, the question you have to ask yourself in this situation is, if I didn't have it, would I want it? The answer comes back immediately. That will tell you whether or not you should keep it, keep full share size, or reduce your share size. But then when you throw the market into the equation, that gives you a much better feel for maybe you're making a right decision for something that's coming in your stock that might not have happened yet, and you can see when crashed. But on the opposite side of the trade is where you get a stock that does exactly what it's supposed to do in a bullish environment. We're not going to go to the daily chart here in OSTK, but my point is you saw the market came down and collapsed hard, but OSTK traded strong. So you can see, again, learning how to read the tape, it was basically a, let's actually go to the daily chart, and then we'll come back to the 5. You can actually see that it was a 3-day consolidation. If you watched the presentation the other day, this is 3 melted candles, 3 indecision candles, but trading near highs, right? So if we go back down to the 5 and read the tape, it was actually below the opening price for most of the morning. Now, you could have entered here if you like the stock long, if the daily chart was well bid, and it wasn't. So you had to wait for what we call a little bit more confirmation, despite the fact that the market was going down. When it got above the opening price here, or even here, you could have now started to consider getting long, and you would have been specifically trading the stock. And instead of subtracting shares, you could have been pyramiding higher into a winning position if that was your plan as a day trader. confidently because the stock was performing as it was supposed to. So 3 parts to unwrap here in Stocks for Breakfast today is first the mindset that it's not set it and forget it. It's not I'm going to lose all of that or I'm going to make all that and I'm going to do nothing in between. Trading, it's called active trading. It's not called passive trading. You have to be actively involved in how you make money. And the more you take responsibility for that, the easier it's going to be for you to manage risk. And ultimately, the easier it's going to be for you to understand how to be net profitable, not only make money once in a while and you break even, which I know a lot of people are doing where they're super smart chart readers, but they can't get to that next stage of understanding how to make money. And what I just walked you through is one really tiny piece of what it means to be in a room with somebody who's a professional trader to walk you through that kind of stuff. So I hope I'm opening up your eyes a little bit to the fact that there's more to trading and it's not complicated. All we did was just walk through is it doing what you expected it to do? And if it's not, how to handle that. The other side is what if it is? And so you can see the difference between reducing share size, setting an alert with the intention of adding those shares back on so you can get your head back on straight and comfortable, which we've had a lot of people discuss some swing trades that they got stuck in. Again, if you're thinking about this stuff through, there's no reason to be hammered on the position. Stock's not going to wear out as long as there's volatility and volume. And then the opposite is when it's moving in your favor and everything is going well, then you have the greatest problem in the world is how to manage your winners. So hope I opened your eyes a little bit today to understanding how to manage risk in positions, both that move against you and those that move in your favor. And if you take nothing else out of this video, just really think long and hard about it's not a bad trade necessarily, unless it is a bad idea. But if a trade's moving against you, there's nothing wrong with reducing your exposure, and you can always put those shares back on. Now, I'll definitely get the argument that, well, I like that price down there better, but if it's moving against you, it's heading back down towards the price that you got. So obviously the time frame and the context of how long you planned on being in the trade matters a lot. What we're talking about here is mostly in that 1 day to 2 week window, depending if it's a day trade or a little bit longer term swing trade. We're not talking about something you're going to dollar cost average in and get out in 2022. That's a completely different scenario. So anyway, thank you for watching Stocks for Breakfast today. If you find these videos helpful, absolutely click down and subscribe. That would be awesome. And if you want to learn more about the boot camp, click down and find out about that too. I'd love to see you in the community. Have a great day, everybody, and please be safe.